Everything I know about day trading, I've learned from David Green, and we've taught in Wall Street Global Trading Academy. If you want to know more and you want to really become a successful day trader, go to Wall Street Global Trading Academy. And that's all I got to say about that.
We're back at the New York Stock Exchange for another incredible interview with none other than the man, the myth, the legend, Mr. Peter Tuchman.
Boom! Chartaddicts, how you doing? Einstein on Wall Street from the balcony at the New York Stock Exchange. Welcome.
Can we compare different crises and just kind of give me your take on
100%.
how different the exchange was and how different the vibe was here? Let's go 01 crisis, 87, 08 financial crisis, 2020. Give me some
100%.
similarities and differences here.
Look, I've given hour-long talks all over the world about the different crises and crashes we've had. And I don't use the word crash lightly because people love to, market goes down 300 points, we're crashing. It's not really, it's an irrelevant phrase in the post-COVID world where we can literally be down 1,500 points at 11 o'clock and already in bear territory, and by 3 in the afternoon we're in bull territory up 2,000 points. So let's reevaluate all of that. But at the end of the day, each one of the crises has had different components that play a major role in the way they unwind and the way the story unfolds. The crash of 87, it's a complicated story. It involved a lot of insurance stuff, but I think the one component that was the same on most of them were that every time we've had a crash or a crisis like that, where the market has sold off double digits and gotten torched, markets had the day before were trading at record highs. At the crash of 87, the day before, the Friday before Black Monday, markets were trading at record highs, and that day the market started to break. We lost confidence. There were some insurance issues. There was a little bit of technical issues going on, not technical like we know now, but the way the machinery worked on the floor. The market started to break down. There was a lot of fear in the market back then because it was trading at sort of a frothy level. And once people started to sell, it's like that line from Trading Places, Mortimer, everybody's selling, sell, then sell, sell. That's what happened. 2000 was the internet bubble. In 1995, 96, 97, similar to today's day, we were raising interest rates because of inflation. The market, the tech sector, which had just sort of was coming to be, was really taking over the market and was overinflating the market in a big way. So we had this wild rise, we had these raising interest rates, we had high inflation, markets hit a super peak, and then the bubble burst. And that's a story that's super complicated, way harder for me to explain it to you now. But as we see, markets go up and markets go down, right? I've often been asked that question, Einstein, do you think the market's going up or down? The best answer I can give you is yes. It's the only legitimate, responsible answer. Let's go to the crash of 07, 08, which I was a big part of because I was here, I was trading it. It had a big impact on me, and it had... So everyone should study that one because it was a predatory situation. So let's think about it for a while. Markets were trading at record highs. Everybody thought that it was a great time to start offering and selling houses to people who could not afford houses, giving credit and credit cards to people who could not afford credit cards. They thought it was a good idea. It was completely predatory. So there were large, Countrywide Finance was one of the big real estate companies that decided to start giving mortgages to people to buy houses. And there was this big push for people who could not afford these things to do it. They were sold houses, they were given credit cards, hoping that being sold this bill of goods, that the market was going to start going up, that the houses were going to be worth a lot more, they'd be able to pay the houses off, they were going to be able to pay their credit cards off, and it turned out that that was not the case. They oversold the market. The market started to crash. It turned out these were bad mortgages because they were given to people who did not have the foundation to support paying the mortgage and paying credit that they could not afford. So what ended up happening was these brokerage firms were left with boxes of mortgages that were bad. What do companies do in finance when that happens is they put them in a nice big box with a bow on it and they sell it to somebody for 50 cents on the dollar. There's always someone out here to buy a bargain, right? Those guys didn't open the box. They used that as assets to trade the markets as well until they realized, oh, wow, maybe we should look in the box and see what's in it. They looked in the box and saw, wow, these are no good. This is bad debt also. So they sold it for 25 cents on the dollar in a different box with a different bow. By the end of the day, all of these things went down the line till the last guy suddenly realized that he had billions of dollars of bad debt. And then suddenly that news came out and the whole market crashed, right? And we had the financial crisis. What ended up happening, the banks that were backing these mortgages failed. The companies that backed these were failed. And what ended up happening was the market crashed, right? Companies went bankrupt and we were in deep trouble. What came out of it afterwards was that the companies that were selling the mortgages were actually betting against the mortgages from working. It's kind of like me buying life insurance on my best friend and then poisoning you to death.
Yes.
I knew the future was going to be your death and I was going to make money on it.
But they just want to package them off and get rid of them
That's
so that
all
they don't have
wanted.
to deal with the bad debt.
Exactly.
Okay.
So it was called credit default swaps. They took insurance out that the policies that they were selling and the mortgages that they were selling were good, right? Knowing they were bad, and then they were going to benefit from it when it failed, and they did. And those people got displaced from their homes, and it was devastating. Look, at that time when it happened, we lost Lehman Brothers, we lost a bunch of firms merged, Smith, Barney, Merrill Lynch, whatnot. People lost their houses, foreclosures up the kazoo. All these companies then ended up benefiting from it. AIG went bankrupt, they got bailed out. Right, at the end of the day, the Federal Reserve, like we recently saw that bail us out during COVID, they threw $800 billion into the market over 18 months, but it took 9 years for the market to get back to even from the crash of 07, 08, the great financial crisis. Think about those numbers. 800 million over 18 months, 9 years to get back to even. $800 billion. COVID came along, never seen that before. The whole world is dying in the streets. The world is shut down. Companies, look, had no way to support themselves because you couldn't cut trees, you couldn't build houses, everybody's locked in place, people dying in the streets. I'm a firm believer that if we did not put the money in the market that we did, we would all be on bread lines right now. So I'm a fan of Jay Powell, and it's proven itself out in the way the market has done since then. We're today here on the floor trading at record highs. So they ended up getting inflation from 8.5 down to 3. Let's stay apolitical. I'm not blaming anybody but the pandemic for all that shit. But what did we do when we were confronted by the greatest financial crisis of all time and a health crisis? The Federal Reserve threw $3 trillion at the market over a 3-month period of time, and we were back to even by August 19th. COVID happened March 15th. I got COVID. I almost died. I got meningitis. I've had 9 surgeries since. My life was changed. I almost lost everything. I was friggin' patient zero. That was March 15th, 2020. By August 19th, 2020, we were back to even. We were up 28% that same year, 2020. We were up 22% in 2021. Now, people say it's a function of the fact that we printed $3 trillion we put into the market. I don't know, it definitely was a contributing factor, but ended up happening was in 2022, suddenly we find ourselves with crazy big inflation. Nobody wanted to go back to work. Those who went back to work wanted to be paid more. Everyone was offline for 2 years because of COVID, had to go online. We couldn't just hit a switch and suddenly we're like cutting trees, building houses, all getting on planes and trains and automobiles. It didn't happen that easily. So the whole world had to go through this higher gas, higher food, higher prices and all that. In order to get through that significantly, we had to take money out of the money supply. How do you do that? Is you raise interest rates from 0 to 5.5% over 18 consecutive raises. Yeah. We were able to get it. So that's a tool that the feds have to curb inflation. That's what they do. They did it. It worked. So all this shit happened, and it's ended up leaving us where we are today, with markets trading at record highs, inflation down from 8% to 3%, and we're in a much better place than we were a bunch of years ago, right? So that kind of gives you a breakdown of all the different components of all the different crashes, right? And it's complicated. You should read about it. It's absolutely fascinating. Markets are extraordinary. They are resilient. They can handle virtually everything that is thrown at them as long as it's like 1 or 2 things at a time. When we see perfect storms, like we saw in 87, 2000, 2007 and COVID, the market does break down. It's resilient enough to come back, and it always does. Over time, markets do go up, but we have had these bumps in the road.
I really appreciate you adding that last part, which is about the resilience of the market, because I feel like that's one of those things that people fear. And I also appreciate you breaking down the slow recovery of 08 versus that sharp V-shaped recovery in 2020.
Yes.
Because most people watching this, their experience probably came from 2020. That's
Correct.
the only crash they know. So they expect the next crash to be just as efficient at rebounding. So I appreciate you breaking down the difference.